You brush your teeth every single day to prevent cavities, right? You don't wait until your tooth is hurting and then rush to the dentist. Your business finances work exactly the same way. You need daily habits to keep them healthy. Now let's talk about financial hygiene. I'm Cece Lang and I'm joined by Alex Ixtock. Today we're covering the daily habits that keep your financial statements accurate and make lenders trust you. The first daily habit we'll talk about is recording every single transaction, no exceptions. Every time money comes in or goes out of your business, you need to record it. Every single time. Let me be super clear about this and what it means in real life. For example, if you sell a product for $50,
record it immediately.
Yes. If you buy supplies for $20,
record it.
If you pay yourself $500,
record that one too.
If you fill up your gas tank for $40,
record it.
And if you buy coffee for a client meeting, it was just $8,
still record it.
And if a customer pays you $200 in cash,
record it.
Great. So from workshop 1, we learned that recording transactions regularly prevents errors and gives you real-time visibility into your business. If you wait until the end of the month to record everything, you tend to forget things, you'll lose receipts, you can't really remember what that $47 charge on your credit card was for, and your numbers are wrong. This all leads to you making decisions based on wrong information. And here is where your chart of accounts becomes critical. Remember, your chart of accounts is a list of all of your money categories like revenue, cost of goods sold, and operating expenses. When you record a transaction, you're putting it into the right category. Let me show you why this matters with a real life example. Now imagine that you run a bakery. You buy flour for say $100. Where does that go? If you're in a hurry and you just pick a random category, you might pick something like office supplies. However, what you want to do is to make sure that you put it in inventory and spend time ensuring it goes into the correct category, because that's what flour is, it's inventory. So this matters because at the end of the month, when you look at your income statement, you need to know how much you spent on ingredients versus how much you spent on office supplies. If everything is in the wrong categories, your financial statements are useless. You can't make good decisions based on bad data.
Absolutely. So let's think of your chart of accounts like organizing your closet. If you have a specific place for your t-shirts, your pants, your shoes, and accessories, getting dressed in the morning is easy. You know exactly where everything is. But if everything is just thrown in a pile on the floor, shirts mixed with shoes, mixed with pants, you're wasting time every morning digging through chaos trying to find what you really need. Your chart of accounts organizes your financial data so you can quickly generate the reports that lenders need. When a lender says, "Show me your income statement," you have the ability to pull that up in 30 seconds. If your chart of accounts is a mess, it could take you days, weeks, or even longer to pull that information together.
And the second daily habit we'll talk about is reconciling your accounts monthly at a minimum. Reconciliation means matching your bookkeeping records to your bank statements. This is your safety net. This is what catches mistakes before they become disasters. Here's exactly how it works step by step. The first step is at the end of the month, let's say January 31st, you log into your bank account online. You look at your checking account balance and it says $5,000. Step 2, you open your bookkeeping system, whether that's QuickBooks, Excel, whatever you use. You look at your checking account balance in your system. Does it also say $5,000? Step 3 is checking. So if it also says $5,000, that's great, you're reconciled. Everything matches and you're done. If it doesn't match, then you have a problem. Let's say your bank says $5,000, but your bookkeeping system says $4,500. You're $500 off. Now you need to find the difference. So here's a few things that you can do. You can pull up your bank statement and look at every single transaction. Then you'll compare it to your bookkeeping system. Look for transactions that are in one place but not the other. Some common problems that you'll find is that maybe you forgot to record a transaction or you recorded a transaction twice. Additionally, it could be things like the bank charging you a fee that you didn't know about or you typing in the wrong amount. From workshop 1, Be the Bookkeeper, we learned that reconciliation is your safety net. It catches errors before they snowball into bigger problems.
Yeah, so let me give a real example of why this truly matters. So let's say you think you recorded a $500 expense for supplies, but you accidentally typed $5,000 instead of $500. That's a $4,500 mistake. If you don't reconcile, you might think that you have way less money than you actually do. You might not buy inventory because you think you can't afford it. You might panic and think your business is failing when it isn't. If you do reconcile, you catch the mistake immediately. You fix it, your numbers are accurate, and you make good decisions based on good information. Or here's another scenario. You think you have $8,000 in your checking account, but you actually only have $3,000 because you forgot to record 5 of your transactions. You write checks for $5,000 thinking that you have the money. Those checks bounce. Now you have bounced check fees, angry vendors, damaged relationships, and a hit to your credit. Reconciliation prevents all of that. Do it monthly at a minimum. Some businesses do it weekly, some do it even daily. The more often you reconcile, the easier it is to catch and fix these mistakes.